So it's gonna start now. Good, excellent. So let's move. Okay, so the sales is fine. So let's move to the variable cost. The variable cost. The variable costs, actually the sales is not working 1, but the sales is working 2. Okay, so I'll call it working 2. And the variable cost, we'll call it working 3, W3. Okay, so we do our cross-referencing, W3. Okay, so just expand it a bit. This one I can just reduce to use them since there will not be more than 3 numbers. Okay, right. Happy? Shall we do the next one, variable cost? So the variable cost also the same thing. The same thing. The variable cost also the same thing. So what we can do is we can copy. Okay, we can copy the first 3. We can copy the first 3 rows and we paste, and then we modify. So what is the variable cost? Who is disturbing us? Okay, variable cost. The demand will still be the same. Okay, 35 and so on and so forth. The I'll put the variable cost here. Okay, you go ahead and use your calculator. I'm using my own way of doing it. So the variable cost, look at it, is taken from 12. The variable cost should be what? 7.8, isn't it? The variable cost should be 7.8. 7.8 multiplied by, let me just do the formula all together. I'll just say equals, the variable cost in year 0 is 7.8. Okay? Multiplied by the increment is 1.04. Okay? So once you do that, look at it, everything else changes. So you have 8.11, 8.44 should be. Because it's not picking the right increment, should be 22 instead. Okay. So that's why now you have 8.44, 22.
In multiply by 1.04.
22. Yeah. Okay, so for the variable cost, it's just the same as the sales. We have the demand. Okay, the first year is going to be 7.8. That's the 7.8 is the rate at year 0. Okay, multiplied by the increment. The increment is what? C22, 1.04. Okay. And then year 2 is going to be the value for year 1 multiplied by 1.04, and so on and so forth. So you should have 8.11, 8.44, 8.77, and the 9.12. Okay, so that will give us our variable cost in dollars as, we'll do the primary school way or the junior school way. And variable cost in dollars. Okay, are you following? Please use your calculator and work, because I think the concept is clear to all of us. So let's just use our calculator and work. So this one will be 8.11 multiplied by this. 8.44 multiplied by 40,000. 8.77 multiplied by 50,000. 9.12 multiplied by 25,000. So we have our...
Mr. Fofana, can we please go back a little bit because I was disconnected? Just a little bit.
We are disconnected.
Please, sir.
Okay, no problem. We'll go back. Don't worry. Okay, so we are trying to calculate our variable cost in dollars. The same thing, the variable cost varies with the sales demand. So we are using the same sales demand. The variable cost we have been given in year 0 is 7.8. Okay, 7.8, and variable cost is supposed to increase by 4% year on year. So this is why the first year we said 7.8, which is the value of the variable cost in year 0, that's now multiplied by the increment, that gives you 8.1. Then year 2 is going to be this, the previous year, the year 1 value, multiplied by the increment, which is 1.04, and year 3, year 2 value multiplied by the increment, and year 4 the same thing. Is that clear, Rosa?
Yes, sir.
Okay.
Thank you, sir.
Then now we take this 35,000, that's demand multiplied by each of the new units now. Okay.
Sorry, Mr. Fofana.
Yes.
I'm only having a difference with you in year 2.
Okay.
In the overall variable cost, because like the first year I have 283,850, but in the second year I have 337,200, while you have 337,600. All the rest are the same.
Yes. What I did was, but did you have 8.44?
No, I have 8.43.
8.43.
Yeah.
Okay. How do you calculate it? You should calculate it using 8. You've got 8.1, isn't it? 8.11.
8.11 multiplied by 1.04.
No, when you are doing, when you're multiplying the when you're finding the year 2, you will not take 8. You will not type 8.11. No, you will type the value. This value here is not 8.11. It's more than 8.11. So you'll say equals. You click on this cell, multiply by this rate, 1.04. Yes, then you should get 8.44. Because you've rounded it to, like, you put 8.11 in your calculator, that's why you had 8.43.
Okay, fine. Thank you.
Okay. Good.
Mr. Fofana.
Yes.
I'm only confused with year 1 variable cost, the 8.11. You know,
the 8.11, how we got it is, we've been given in the question that the variable cost at year 0, now, is 7.8. Okay? So if the variable cost now, at the market price, the variable cost at the market now is 7.8. What about in year 1? In year 1, it's going to increase by 1.04. It's going to increase by 4%. So that's why you take 7.8 multiplied by 1.04. If you want to be a non-accountant, you can take 7.8 multiplied by 4%, and then you add 7.8 to it. If you want that, you can do that as well. But let's leave that to the non-accountants, yeah? If you do that, you get the same thing. Okay, shall we move?
Yes, yes, yes.
Okay. Right. So now what we're going to do is we're going to do the same thing. We're going to do the same thing. We're going to take our variable cost here. For you, please use the is it the how to call it the senior school or the junior school method, yeah? Divide by 1,000. For me, because I'm using a computer, I'll just use this. Then I'll copy this format and then I'll paste it here. So I have 284, 338, 439, 228. Correct.
Okay, Mr. Fufana, can you give us a few minutes? Let's write this thing down.
No problem, no problem.
Hello, Mr. Fufana.
Hello.
Yeah, it's getting late and I think it is kind of slow. So why not like we actually, allow you to work, then from there we can watch the video and work by ourselves, That's my suggestion, Because right now I'm not even at home. I'm attending the class at home.
No, let's
Yes, Mr.
just finish. I don't mind. We'll finish.
The
We'll,
the
sorry?
is very poor.
The network is poor.
I think the connection also, the network is very.
Yeah. Now let's agree.
Yeah.
Yeah,
Let's continue.
let's put it this way.
Let's continue. I think not because even I myself am not at home. I'm at Olympic right now because at home the network is always very poor. So I will come all the way to Olympic in order to be able to attend classes. So I think we should be up with each other. Sometimes when you go to download certain things, it's just a problem at home. But we can continue, it's fine.
Yeah, just like me, I'm also at the office here in Carnifing. I left all the way Bruce Lee. So please, let's just complete. For some of you who are finding it difficult, if you want to go, you can go and maybe watch the video later. But I want to complete with the rest of you because definitely today will be the only day that I'll be available to complete this. I have other things to do as well. Yeah. So let's just be and complete this. I myself, to be honest, if it were not my promise, I will not attend this class today. I'm really, really tired. I have serious headache as I'm talking. So please, let's just be here, yeah?
Iti feke jibe la tata ya. Jana jibe la tata ya kura spek ko sola mimba.
Hello? Shall we continue? Amadou, yeah. So don't mind. If you want to
Yes,
excuse
please.
yourself, you can. And then you can watch the video later, but we'll continue, to be honest, because we have a lot to cover, and I think it's really important. This question is very, very important. Okay, so now we've got our sales, we've got our variable cost. What should we calculate? Our contribution, isn't it? Okay, we should calculate our contribution. So our contribution will be sales less variable cost. And we just replicate that. So we have a contribution of 149,000, 172,000, 217,000, and 110,000. Hello?
Yeah.
Yes, Mr. Fufana, that's it.
Okay, shall we continue?
Yes.
Yes, we can.
Okay.
We have no choice.
Sorry?
We have no choice, so we can continue then.
Mr. President, if I tell you my case, you won't believe. Since 9 o'clock in the morning, I'm having class up till now.
You people are very lucky. When you people start complaining, I will laugh because when I was going to school, I mean, when I was doing all these courses, it was crazy. Well, I told you some of the things, you won't believe them, but my experience was a lot more painful than yours. Very, very painful. Very painful. So to me, you are definitely enjoying. So if I see you complaining about, having class, morning to evening, in my own case, I'll have that and then I'll go to work, continue. The following day also, I continue like that. Sometimes I sleep for less than 2 hours in my bed for 2-3 days, so it's, anyway, I think
I was
that's,
having connection problem throughout the day. So I just have one question: whether Hannah, today is the final and the last class, or you'll have another class? Yeah, I'm just joining. Today, really, I was really having a connection problem.
yes, this
Also on and off. So
yes, yeah. This is
was
our
not
last
easy.
class today, inshallah. This is our last class.
Okay, thank you, sir.
So
Thank
we
you,
have our
everyone.
contribution of 149, 171, 217, and 110. Okay, so let's calculate our fixed production overhead. We'll do that here. I just abbreviated FO. Okay, I'll just call it FO. I'll just call the security to put the generator on. So, right, so the fixed overhead for year 0 is given to us at 25. Okay, so that's, we can say 25,000 multiplied by the rate. Where is our rate? Our rate is 1.06. We enter. Okay.
1.0.
So that will be 27.
Mr. Hannah, please, what did you just?
Yeah, what I did was the fixed overhead. That one we can do the work in here. We can do the work in here. Okay. So what I did was I just took the initial fixed overhead is 25,000, and it's going to go up year on year at 6%.
Oh. Okay.
Then
Okay.
Then for year 2, it's going to be the previous year multiplied by this. F4, we enter, and we replicate.
This is the 25,000 fixed overhead.
Yes.
You said the fixed overhead is
The first year is 25,000 we've been given, and it's supposed to go up by 6%.
yes, I know. I saw the 6%, but the 25,000. Okay. I saw the 25. The fixed production overhead. Okay, thank you.
Yes. So you have 27, 28, 30, and 32.
The 25,000, you multiply it by this 1.06, right?
Yes.
Okay. Thank you.
Then we'll have our net cash flow. So we have our net cash flow. Okay. So our net cash flow will be equal to our contribution less fixed overhead. Okay, so that would be 122. 122, 143, 187, and 78. Okay, so that's what we have as our net cash flow. Okay, so
Sorry, how do you ascertain that, please? The net cash flow?
yes, after my contribution, you know, we deducted the fixed overhead from there. Okay, we deducted the fixed overhead from there. So the fixed overhead is 27, 28, 30, 32. Okay, and then we'll have our net cash flow. So this is the net cash flow before taxation. Okay, so just take note of this. We are going to deduct tax from our net cash flow before taxation. Okay, mind you, we didn't put any depreciation into consideration. Okay, so we're going to apply tax twice. One, it will be tax on our net cash flow, and then two, we will gain tax benefit. The tax benefit will be on our asset, on our PPE. Okay, so we're going to do our workings to arrive at that. But for now, let's do our tax, the tax on the net cash flow. Okay, so I will do tax. Okay, so the tax on 122 at 30%. We've been told in the question that the tax is at 30%. Okay, take note of that. The tax is at 30%. Pays tax at an annual rate of 30%, 1 year in arrears. Okay, in fact, they should not have said it, but they've said it. Okay, so because of that, I have 122 as my net cash flow. So I want to calculate tax of 30%. So I'll say equals this multiplied by 30% is 0.3. Okay, so I have my tax like this. Okay, so my tax is 37, 43, 56, and 23. Okay, is this correct? Huh? Hello?
Yes, Mr. Formula, it's correct.
It's correct?
Yeah.
Okay, you all agree it's correct the way I did it? And the way it has been aligned, is it correct? Is it correct?
No, Mr. Formula.
Yes.
Mr. Bowe,
Yes, Ansumana.
Yeah, this 37 is supposed to be in year 2.
It should be it?
Year 2.
Why? It's tax for 122. Why should I put it on the year 2? Why?
So you pay tax in areas.
You
So
pay tax in
will
areas.
be paid in year.
You pay tax in
Yes.
areas. Me, I'm not an accountant. What does that mean? What is in areas? Me, I don't know that. What's that?
This year, the first year's tax will be paid in one year.
Okay. So that's what means in areas, huh? Hello. Yes.
Hello,
Mr.
Mr.
Formula.
Mufala. Calculating the tax. I stopped at the net cash flow.
Yeah, the tax we are just applying tax rate of 30% on the net cash flow. So that's what we are doing. But what we are saying is we just applying it just under their ear, and somebody says that is wrong. So I want him to convince me that it's wrong. Answman, yes, go ahead. Yes.
What I'm saying is, the tax for fourth year will be paid in the second year.
Why? Why will it be paid in the second year? Why will it be paid in the second year? Huh? Okay, you're right.
Mr. Fufara, because tax is normally paid like not in the like taxes are always paid a year after.
Okay, why are they paid a year after?
Mr. Fufara,
Now,
I think because this first year,
it's not a good year. Okay, you're breaking. Look, let's say it has. We've been told in the question that taxes are paid in arrears. But what I'm saying is this was not, in fact, a good exam question. They shouldn't have told us. It's simple. It's simple. Look, you cannot pay tax on a period that has not ended in the first place. If you're going to pay your tax for 2019, 2019 must end, it must be audited, and then you pay your tax. So you don't even have to memorize the phrase tax is paid in arrears, rents are paid in advance. No, simple. Okay? So taxes are always paid the following period, the following year. If it is quarterly, for quarter one is to be paid in quarter two. For quarter two is going to be paid in quarter three. For year one is going to be paid in year two. Oh, shit. Sorry, let me just put this.
Hello? Hello?
Rosa,
Uncle,
just give me 1 minute. Just give me 1 minute, please. I'm taking a call. Just give me 1 minute. Okay, sorry about that. I was receiving a call. So okay, so we've got the tax. Yes. So just like what was it Abdullah who was talking? Okay, Ansumala. So it's right. Yes, tax has to be paid in arrears. Okay, it has to be paid in arrears. So that means this tax here will have to be paid the following year. So we start calculating from year 2. So we said equals that cash flow multiplied by 30%. So that will be 37. Okay, so you see now the 23 will be paid in year 5. Okay, the 23 will be paid in year 5. Okay, Ahmad, you wanted to ask something? Rosa, you wanted to ask something? Hello?
Hello, Mr. Fofana?
Yes, Ahmad, yes.
Yeah, I have a question. Suppose in exam, this areas is not mentioned. You assume that it is paid in area, the tax.
No, if it is, this is why I was saying the examiner was very easy. In fact, this must have been how to call it a model paper, and then they've elaborated on it. But usually they don't even mention it because that should be automatic. You should know as an accountant that you cannot pay for corporation tax in the year of the business. It has to be the following year. So if they mention it, then it's a bonus for you. If they don't mention it, you have to calculate it in areas. Okay?
Okay.
Good. Okay, so let's go and calculate our tax benefits. Our tax benefit is the tax on capital allowances. So we say tax benefit with a capital allowance. Okay, so we're going to do working for. Okay. So we're going to do working for. Okay, are we together? Shall we move?
Yes, please.
This is the most tricky part. We know that we've got a net cash flow, and that net cash flow, we need to calculate tax on it. Fine. But then because we have not put any, we did not deduct any depreciation here from our profits. That's why it became a cash flow. Because we have not done that, the taxman wants to be generous. The Inland Revenue in the UK, as it is called, and then the Gambia Revenue Authority, as it is called in the Gambia, will give you, it's in fact the same way. For those of you who may be involved in payment of taxes in the Gambia, GRA also does, they also provide capital allowance tax benefit. Okay, so you usually deduct that from the tax that you're going to pay. Okay, so we're going to calculate that tax. So we go to working for. Okay, so we'll have
it's 20 hours.
W4. We will have working for. So our working for will be calculation of capital allowance. So we calculate capital allowances using a reducing balance method. So we'll have year 1, the asset was bought for 250,000 and is going to be depreciated over 4 years. Okay, at the end of the 4th year, we will sell it and get a benefit of 5,000. So mind you, that benefit will be a cash benefit that we will get at the end of the 4th year. Okay, so that will be a tax benefit. Sorry, that will be deducted from the final WDV, but then the 5,000 itself will be an inflow that we will realize in year 4. So please let us not forget about it. But for now, we are interested in calculating our WDV, our capital allowances, and our tax on capital allowances. So we'll have the year. We'll have the year, and we will have our capital allowance. So capital allowance, in other words, is like calculating depreciation using reducing balance method. Finish. That's all. Using reducing balance method, calculate depreciation. So we'll have capital allowance, then we'll have written down value at the end of every year. So that's what we call WDV, written down value. So the written down value will be if you deduct the total amount from the capital allowance for every year, whatever remains, or it is the same as the net book value of the asset every year. So the tax plan calls it written down value. Okay, so we have the capital allowance, we have the WDV, and then we have our tax benefit. We have our tax benefit. The tax benefit will be on the CA. Okay, and it will be 30%. Okay. It will be 30%. Okay, so this is the format that we're going to use. I'm going to wrap this so you can all fit in one. So I'll go down a bit so you can see it clearly. So it's going to be year 1 to year 4, year 1, year 2, then we can replicate the next 2. So the first capital allowance for year 1, how are we going to calculate it? Mind you, we've been given the capital allowance rate by the taxman at 25%. That is different from the 30% of tax. So the first year capital allowance, how are we going to calculate it? Hello?
Yes, Mr. Fofana, we will say 250,000 multiplied by 25%.
Excellent. We'll say, so you see, Cisse, you are just complaining that you are tired, but you are not tired at all.
This is the one I'm tired because I don't know what to say. I went outside so that I can have connection.
Okay, yeah, connection is a Gambian problem. We need to manage it. Let it not hold us backwards, man. Come on. Let's manage it. Okay, so 250,000 multiplied by 25%. 25% is 0.25. Okay, so that's 62,500. That's our first capital allowance. Okay, so I'm going to put it into, I'll format it into 1,000 separator, but no decimal place. Okay, so is that clear? So the first capital allowance is 6,250. Now, what is the written down value after this first year? Yes, Amadou?
Mr. Fofana.
Yes, Rosa?
Yes, sir. Even that 250,000, we have to divide it by 4, 62,500.
Yes, yeah, of course, multiply by 25% is like a quarter of it. It's the same as dividing it by 4, correct?
Yes, sir.
Yes. Okay, so what is the first year's WDV or the NBV, written down value? It will be whatever remains after our capital allowance. Our capital allowance, we are considering it as depreciation. Okay? So after you depreciate for the first year, what remains on your net book value is the total of the asset less the depreciation amount, isn't it? So it's going to be equal to 250,000 minus the 62,500. So this is going to be the same for all of them. So I just do.
Mr. Popona.
Yes, sir.
Why don't we do it in this way? First year, 250,000. Then we have the lifespan of the asset, which is 4 years, right? Now you have instead where you have this WD, you can have the year in that column. Now when you divide that by 250, you have the net book value on the other side, right? Okay, then that net book value now, or the WDV, you can now subtract that from that other 250, then you have the net book value. Yeah.
So you mean to
then taking 25%. Yeah, then taking 25,000, multiplying by 25% to arrive to this, and then there again you go. That don't you think is a long process?
What I think, if I understand you well, what you are saying will be a situation whereby you're dealing with a straight line. We are dealing with a reducing balance here. Okay? So whatever we do is the first year, we calculate our capital allowance, which is like the depreciation for the first year. Okay? And what is the remaining balance after the depreciation? That's why we had the 250,000 less what was the capital allowance here to give us this. Then now, whatever this balance is, we're going to multiply, okay? We're going to multiply this balance with 25% again, 0.25. Okay? So that gave us 46,875. Okay? And if that is the case, then what will be our written down value now? Our written down value will be the previous one, this minus that. Okay, so that will be 146.25. Let's take it step by step, Amadou, okay? Step by step. So in year three, we'll have a remaining written down value of 140,625. So this 140,625, we're still going to apply our 25% capital allowance on it, our capital allowance rate on it, so that we can get our capital allowance. So we say equals this multiplied by 0.25. So that gave us 35,156. Okay, 35,156. So what we're going to do is we're going to use our previous balance. Okay, we're going to use our previous balance, which is 146.25 minus the 35,001. That gives us our 105,469. Okay, so far so good.
Roger.
Okay, excellent. Now, year 4 is the final year. Okay? Year 4 is the final year. As such, there should not be any written down value remaining. Why? Because in year 4, the asset was disposed of. Okay? So that means the capital allowance in year 4 is whatever remains in year 3, okay, less the scrap value. Let me say this again. In year 4, that is end of year 4, the asset does not exist because it was sold. Okay? So if the asset was disposed of in year 4, there should be nil balance in year 4. As such, whatever remains in year 3, less the cash proceeds, the disposal proceed, okay, will be the capital allowance for year 4. So that there is a nil balance here. So we say equals this minus what is the cash proceed, the disposal proceed? 5,000.
5,000.
5,000. So we have 5,000, and the balance here will be nil. Okay, so our capital allowances should be 62,500, 46,875, 35,156, and the final year everything excluding the cash proceeds of 100,469, and that will give us a 0 WDV. Clear? So now.
No, Mr. Fofa. Sorry.
Yes. So.
It's not clear. How do you get the 100,469?
Yes. How we got it, we've been told that this asset has a lifespan of 4 years. In year 4, the asset will be disposed of. Okay? So for year 1, you understood how we calculated the capital allowances. We take the full cost of the asset, multiply by 25%, gave us our capital allowance, which is the same as our depreciation using our reducing balance method. Okay?
Yeah, that I understand.
Okay, then you deduct the 62,500 from the 250,000 to give you 187,500. Correct? Then you bring forward that 187,500 multiplied by 25%. That gives you 46,875. Okay, so that's 46,875 less the previous balance gives you 140,625. That 140,625 will be brought forward in year 3, and then the capital allowance rate will be applied on it at 25% to give us our 35,156. After having our capital allowance of 35,156 in year 3, less our previous balance, it will give us our 105,469. So that means this is the written down value of the asset at the end of year 3. Mind you, if you say the asset has been sold in a particular year, that means end of that year, the asset should be 0 in value. Do you agree to that?
Yeah, I agree.
Excellent. So because of that, in year 4, assuming that there is no disposal proceed, the capital allowance for year 4 should all be this whole 105. But because there is a disposal proceed, we're going to knock off that disposal proceed from the balance that is brought forward to give us a net of this. Okay? So that in year 4, there will be no WDV. Okay? So this is the way we arrive at our 100,469. Is it clear now?
Yeah, it's clear. So like if you're using like spreadsheet, if you automatically less 5,000 here, is it going to automatically give you 0, or you are the one who just insert the 0 here?
If you're going to use, well, I just inserted like if you want to in this case, because what we have been doing was getting the previous one unless this one. So here, okay, here you want us to, like when we put it in a formula. So when you put it in a formula, it's going to be equals, okay, this minus, you must minus the 5,000 there, and then minus this to give you 0. Okay?
Oh, yeah, okay, I get it now.
You got it. Okay. Good.
Okay, Mr. Fofana.
Yes, Mari.
Yes, in a situation whereby, how to call it, that 5,000, it was not sold.
Okay.
If at all, it was not at all. Then it's like this 105,469 is the one we would bring down here, right?
Exactly. So that will be the full capital allowance that will be at year 4.
That will be at year 4. Then
Yeah.
here the written down value will be 0.
Yes, and then the written down value will be 0. Yes.
Okay, sir. Thank you.
Good. Okay, so now we calculate our tax benefit, which will be 30% on the capital allowance. Okay, so we say equals this multiplied by 0.3. The same rate as the tax we've used on that one. So we just duplicate up to here. Okay, so let's take it to our 0DP format. We do our number formatting. Okay. So we have 18,750, 14,063, 10,547, and 30,141. So this is very important for us because this is the tax benefit we are going to receive from GRA. So as such, this should go and knock off our, it should be deducted against the tax we are supposed to pay.
Yeah, sorry, Mr. Fofana. Can you please come again on how you get this? The figures in the tax benefit column, please.
Yes, the figures in the tax benefit column is the tax rate on the capital allowances. So these are our capital allowances, yes?
Oh, okay, thank you. I was using it on the written down value.
Yes. So these are the figures of our capital allowances. So you apply 30% on that. No, the written down value, that one is not, it's not important anymore. It allows you to calculate your capital allowance. Okay. So that's the way to go. Right. So we can go and plot those ones. So give me the numbers. Let me do the junior school method. Yeah. So this one also, it will be in areas. It will also be in areas. So the first one is what? When we round it up, 19, huh? 19, 14, are you with me? When we round this to the nearest 1,000, this will be 19.
Yeah,
14,
yeah, it will be 19, 14,
11
and 30.
11 and 30. Okay? Is it clear? So let's have our after-tax cash flows.
Correction, we never do that. We
never pass it off, sir. After-tax cash flow. Don't underrate it. These are the kinds of questions you will see in your exam. So that's why if I miss out on today and you don't see me again and you see something like this in your exam, you'll start blaming me. Well, you have not taught us this. So please bear me out. Let's do this. So the after-tax cash flow, we're going to get the net cash flow that is in there. We add the tax benefit, which is an inflow. Okay? Let's put it this way, sorry. Say equals the cash flow here. We add it to the tax benefit and we less it from the tax. You know, the tax benefit is an inflow, and we just duplicate. So I have the after-tax cash flow of 122, 126, 158, 33, and 7. So due to rounding off, I have 143 plus 19, that's 162 Right. Okay. So you have same numbers here. 143, 37.
That is, let's say after tax.
Yes, because there is a rounding up there, so this should have been 125. It's due to the
No,
rounding.
what I want to know, how do we arrive to it?
The after-tax
How do
cash
we
flow.
arrive to it?
Yes, yes.
Is it
How
tax?
after-tax cash flow? So we know we've all come up to here to our net cash flow before tax. That is this. Okay, that is this. Let me color it in blue. Okay, now we have our taxes. Okay, this one is a tax outflow we have to pay. This is a tax savings, which is an income to us. So what we do is this plus the income, which is our tax benefit, less the tax, that gives us this for each of them. Is that clear? So our
net cash flow plus tax.
Yes. Our after-tax cash flow is 122. Okay. 125, 158, 33, and 7. Okay. So we have not finished the cash flow. I told you that we had a disposal proceed of 5,000. When will that come? Our proceed from disposal. This is like it's an inflow. When will that come? In year 1, year 2, where? In which year? Year 5? It will come at the end of
year
the
5.
year. At the end of the useful life of the asset will be year 4. Yes. So we'll have an inflow in year 4. Yes. So our after-tax net cash flow after-tax net cash flow total will be this. So we'll have this plus that. Okay. Okay, so we have 122, 125, 158, 38, and 7. Okay. So now we are almost done. We are almost done, but there's one thing that we're supposed to do, which is the calculation of our discount factor. Okay, we have to calculate our discount factor. And our discount factor is not given to us on a plate. Okay, so we have to look for it. What is given to us on the question is, it says this.
No, it will be in year 4.
Sorry? No, I'm talking about before we do our discounting, we have to use a discounting factor. So the discounting factor rate is not given to us because what is given to us, what we're supposed to find is the, how to call it, the nominal rate. Okay? We're supposed to find the nominal rate, but what is given to us is the real rate and the inflation rate. Okay? So Tego has a real cost of capital of 5.7 and pays tax at 30%. 1 year in arrears, it can claim capital allowances on a 25% reducing balance basis. General inflation is expected to be 5% per year. Tego has got a target return on capital of 20%. Depreciation is charged on a straight line basis over the life of the asset. Okay, so the rate that is given to us in the question, the cost of capital rate, or the rate that we should, how to call it, we should reduce our cash flows, our future cash flows to today's values, is not what is required. Okay, so what is required is the nominal rate, but what is given to us is the real rate and the inflation rate. So to find the nominal rate, which we use for our cost of capital calculation, we use a function that was given by one scientist called Fisa, and it is called the Fisa Effect. Okay, the Fisa Effect says 1 plus nominal rate is equals to 1 plus real rate multiplied by 1 plus inflation rate. So the rate that we have to use to discount our cash flow is not given to us in the question. This is what I'm saying. We have to calculate it, because the rate that is given to us is only the real rate and the inflation rate. What we need, always take note of this, what you need to calculate your, to discount your cash flows is your nominal rate. Okay? So we have to find our nominal rate. So we go to another working. Amadou, the question is becoming tougher and tougher. Huh?
I'm telling you, sir.
Probably fine. So we have to find our nominal rate. We have our,
this kind of Nyankatan is very, very salty.
You know, if the Nyankatan has got more nyama nyama in it, that's when it becomes nicer, huh? Okay. So we
not this one. This is of bone, less fish and lot of bone.
It's less fish.
Yeah, instead of talking people now, that kind of Nyankatang, I will not eat it.
I hope this one is not the Nyomika Nyankatang, huh?
Exactly. This Nyankatang will only be nice to Mr. Fufana, but not to us.
No. It's a Nyomika Nyankatang.
Exactly, it's a Nyominka one.
Yes. Okay. So let's do the Fisa effect. We call it the Fisa effect. Okay. This was developed by a scientist called Sir Ian Fisher. Okay. So what the Fisa effect says is 1 plus nominal rate, 1 plus nominal rate equals 1 plus real rate multiplied by 1 plus inflation rate. Okay. So this is what the Fisa effect says. So what we have been given in the question is the real rate and the inflation rate. So we should use this constant to calculate our nominal rate. Okay, so let's break it further. So for nominal rate, I'll just abbreviate it. So I'll say bracket opens 1 plus NR equals bracket opens 1 plus. We know our real rate is given in the question. What is our real rate that is given in the question? We were told that the real rate of
5.7.
5.7.
Okay, 5.7. So that will be 1 plus 5.7% is the same as 0.057. Isn't it? Okay. Multiplied by 1 plus, okay, inflation rate. What was the inflation rate also given in the question? What was the inflation rate given in the question?
5%.
5%. So 5% is 0.05. Bracket closes. Enter. So we are doing maths, only maths that we're doing now. So we say 1 plus NR, sorry, all right, 1 plus NR, bracket closes, equals, okay? So 1 plus NR equals, so let's expand the brackets. The first bracket is what? What is 1 plus 0.057?
1.0.057.
1.15.
Sorry.
No.
1 plus 0.057 is the same as 1.057, isn't it? 1.0.
1.057.
Okay. So it's so 1 plus NR is equals to 1.057 multiplied by, what is 1 plus 0.05?
1.0.05.
1.05. Excellent.
1.0.
Okay, good. So we are breaking it down one bit by bit. So now 1 plus
NR.
1 plus NR, 1 plus NR is equals to what? What is 1.057 multiplied by 1.05?
1.1099.
No, do 1.057 multiplied by 1.05. How much do you get?
Well, that's 1.10985. So to 4 decimal place.
Take it to 2 decimal place.
1.11. 11.
1 point? Okay, 1.11. Good. So 1 plus NR is equal to 1.11. Okay? So now, using our simple change of subject, what is NR?
NR equals to 0.11.
Hey, NR is equals to what? Change of subject.
0.11.
1.11 minus 1.
There you go.
It's 1.11 minus.
The 1 is going to change position. So the sign will change. You know, mind you, the sign of this 1 here is a plus. So it's going to be on the right side of the equation. So the sign will change to minus. So it's 1.11 minus 1. Okay? So now we are not doing any accounting there. So please, if you don't know this, blame your maths teacher, yeah? So what is NR now?
NR is 11%.
Yeah, that's what I said, 0.11. 0.11.
And what is 0.11? What is 0.11?
11%.
There you go. So NR is 11%. So NR is 11%. So we are going to use 11% as our cost of capital to discount our cash flows. Now, yes?
Yeah, can I take you back? You know, this point, this capital allowance.
Yes.
I just want to take you back. You know, this 62,500. You charge 30% to that, right? And then this 18,750.
He says, sorry, the 62,500.
Yes. I think you charge this 30% on that to get the answer there.
Yes, 30% on that.
But I don't know. I'm getting I'm having different answer. If I charge 30% of that, it gives me
I think it should
Now,
be 25%, not 30%.
8740.
30% on what? What is he talking about?
That's
Are you talking about the tax benefit on capital allowance?
Yes.
Yes, it's 30% on 6,500.
6,500.
25%, Mr. Fofana, not 30.
No, it's 30%.
You mean where we got our 18,750?
Yes.
Yes, 18,750 is what? It's 30% on 62,500.
No, but if you do that my calculation, I got 8740. I don't have this 18750. When I use this 62,500, you multiply it with you charge 30% on that. If you charge 30% on this, I have 8740. Not
8740.
Yes.
62,500 multiplied by 30%.
Yeah, I don't know if the calculator or what. Do I have 8740?
Ansumana, reset your calculator.
It's 30%.
It's my calculator, right?
No, I think what we are saying and what Answana is saying is different. The 30%, the 25% is on the capital allowance calculation on the 250,000. That's we apply 250,000 multiplied by 25% gives you 62,500. I think what Answana is asking is how do we get the tax benefit on the capital allowance? That's this 30%. So it's 30% you multiply by 62,500. That's what my calculator gave me, and everybody else.
That's what I'm saying. I'm confused because my calculator is not giving me that.
They say you should reset your calculator. Maybe do that.
Okay, thank you.
Thank you. Okay, so right. So we all know how we get our nominal rate, yeah? Okay?
Yes, sir. Please let's proceed.
Good.
Any shortcut to this? Any shortcut to that nominal rate?
No shortcut. Shortcuts are not good cuts. Rosa on that. Okay, so let's calculate our discount factors on 11%. So we have our DF on 11%. Okay, so our discount factor on 11%, can we calculate it? We say equals 1 divided by 1.1, sorry, 1 divided by 1.1. Okay, we close our bracket. 1 divided by 1.1 raised to power 1. Okay, so let's take it to 3 decimal place. So we'll take everything to 3 decimal place. Okay, to 3 decimal place. So like I said, if you're going to use your calculator, so do equals 1 divided by 1.1 raised to the power 1. Okay, whatever you have as your answer, inside your scientific calculator, divide that by 1.1. If you divide that by, like here, this answer that you have, you should divide it by 1.1. Then you should get, sorry, what am I'm doing correctly. Sorry. This answer here, divided by 1.1. 1.1 is 1.11. Mind you, this should be 1.11. 1.1 is 10%. Okay, so the fourth one you should have 0.901, 0.812. Okay, so first take your calculator and say 1 divided by bracket open 1.11 bracket closes raised to power 1. Okay, then you enter. After doing that, now that answer you got in your calculator, don't clear it, say divided by 1.11. Then you should have 0.812. Then after that, just continue pressing equals. Then it will give you the next one. You press equals, it will give you the next one. You press equals, it will give you the next one, like that. Okay? So you'll have 0.901, 0.812, 0.731, 0.659, 0.593. Okay, then we have our present values. Okay, we'll soon stop. I think what I'll do is I'll explain the B part to you, and then also the IRR, then you can just go and look at the IRR is very, very similar to this. So what you need to know is only the formula. Okay, so I think we'll stop very soon because people are really tired. It's coming to 9 o'clock now. Okay, so we got this done. We take it up. Forward number. We take it to 0. So we have 110, 102, 115, 25, and 4, like that. So actually, because of the rounding, if you multiply them, you should get 110, 102. That's if you remove them from the calculator, you multiply them. These are the numbers that you should get. 25, and then 4. Okay? Are we together? Are you following?
How did you get the PVs? Present value.
Yeah, the PVs is the after-tax cash flow multiplied by the discount factors. So that's what I did. So what you'll do is after calculating this, remove them from calculator and type in your calculator newly 0.901 multiplied by 122. Put in your calculator 0.812 multiplied by 125. Okay, and then you'll have this number. Otherwise, if you
thank you.
Calculate this and then you use the answer on this without without going back to them, then you will get a different number. You'll not be wrong, but then it will be better to do it that way. Okay, so I'm going to do the PVs. I'm going to insert 3 new rows above. Then I'll have PV of benefits. PV of benefits. PV of investment. Benefits is the same as the sales, yeah? Investment is the cost. And then we have our NPV. So the benefits, we can add them up from here. All of them. And that of the investment is 250,000. It's 250. And then the difference is the NPV. Done. So the NPV is 106,000. Okay, we are done now. We are done with the question. The long question.
Well, I hope this type of question is not coming on the
This
exam,
type of
right?
question will come in the exam. I'm saying it, and I meant it.
Oh, that's how I will speak fuller to you. Trust me.
If you speak, I'll understand it. My mother is fuller, so if you speak, I'll understand it. Okay, yeah. So to be honest, the question is not difficult. It's just cumbersome. It has got a lot of bits and pieces, eh?
This one is not easy there.
Who told you this is not easy? And I'm warning you that if you are going to expect a question on, of course, let me not say if you are going to expect it. You will definitely get a question on investment appraisal, and it will be something similar to this. I think I made myself clear. That's why I'm taking all my time. Please, if you don't understand anything, I'm here. Let's do it. And the good thing is, if you go back and watch the video, you'll be able to get it. You'll be able to, because all this is recorded. Okay, all this is recorded. So the part B, we are not going to do that. I'm just going to explain it because that is ARR. Okay, so the part B, we are not going to do because definitely it's late. And I think everybody's tired, including my humble self. I'm very tired. In fact, more tired than anyone else here. Just that people are complaining of time also. Okay, so the B part.
Sorry, Mr. Fofana.
Yes, yes.
How will you know that you are to find like the nominal rate?
Oh, it's given in the question. Okay, the key is if you have, please take note of this. If you have any exam question, and please, and this is going to let me tell you a secret about NPV. Let me tell you something. Please allow me to learn. Let me tell you something about NPV. If you are going to continue as an accountant, please know that NPV is going to be with you forever. Especially those that are going to do the master's degree and also the professional exams. NPV will come big time. It's very famous, it's very useful, and it will come with you. And they can do it in any form. They can mix it with everything else. So the key is, if in the exam question, you are not given a rate directly, but they are telling you that the cost of capital is this, there's inflation this. So the key is, once you are given an inflation rate and another rate, know that the rate you are given is inflation and real rate. You have to find the nominal rate. Always put at the back of your mind that it is the nominal rate that you use in your discounting. Okay? So in case you are given the real rate and your inflation rate, you should use the Fisa effect to calculate your nominal rate. And it's very simple. I just try to take it to you step by step, but it's just a simple change of subject. Simple.
Yeah, that is simple. But then for you to find out, like, this is what you are to calculate, that is the issue.
No, I told you the key. Once you give it so many rates, you should know that the rate I'm looking for is not there. They want me to find it.
Okay.
Yes.
So when you are given only one, then you know that is like the discounted factor rate.
Exactly.
Thank you.
That's the rate.
Thank you.
Yeah. Okay. Yes, Roger, you want to ask some questions? Please feel free to ask me any questions. And even after class, how to call it? If you feel you don't understand anything after watching the video, I'm free. Sometimes it may be difficult to get, because some engagements because of my engagements and stuff. But then I can always help with any explanation you want. Right. So please let's look at. I just want to explain the B and the C part, and then how to call it how to call it, the IRR. The IRR is very, very similar to NPV. Okay, very, very similar. The IRR, you only need the formula. You do NPV calculation, you do 2 discount rates calculation, and you plug it in the formula. Simple. It's not difficult at all. Okay.
Mr. Fofana.
Yes, Mary.
What the proceed, is it that amount the how to call it, the product was disposed with? Disposed of?
Yeah, the proceeds is the amount of money that you will get when the asset is fully utilized, like when you sell it. You know, we're trying to acquire. So at the end of the year, at the end of year 4, the machine will have been overused, and we're going to sell it off. So if we sell it, we're going to get 5,000. So that's an inflow.
Okay.
Okay. So let me explain B and C, and then we will discuss when we should take our exams, and then we call it a day. Okay. So the B part, I'm going to explain it, but I'll definitely give you the solution to it. I'll give you the solution. I will send it to you on the WhatsApp group, but I'll just explain it. Okay, the B part is asking for an ARR. It says calculate the before tax return on capital employed, that's in bracket accounting rate of return based on average investment. Okay, so simple. So it's asking for weak numbers, the before tax, okay, the before tax cash flow. So that is the numbers that are 142, 143. You see the net cash flow before you put any tax in there. So the 122, 143, 187, 78. So those are the numbers that you're going to use, okay? So those will be your income, okay? So you add all of them, you calculate your total depreciation. Your total depreciation will be what? Just like when we are doing our ARR, our total depreciation will be what? Is it not the 250,000 less the scrap value, 5,000? So
yes, it is
5,000. Okay, so when you add all the net cash flows before tax will give you 530,000. So your total depreciation will be 245,000. Okay, so you knock it off, and then you find the average, divide by 4. So your average profit will be about 71,250, and your average investment will be, of course, 250 plus the scrap value, the 5,000 divided by 2, that will be 127. Then you find your return on capital employed, or your ARR, that will be 56%. But I'll give you the answer on this something. Then the last, the part C is the how to call it. You discuss the strengths of internal rate of return. Okay, so internal rate of return, we're going to look at it briefly, 5 minutes. It's very, very, very similar to how to call NPV analysis, but the only difference is in IRR, what you look at the how to call it. You look at the discount rate. You calculate the discount rate in which NPV will be 0. Okay, so it's also a DCF technique. Okay, in IRR, you will be given a target return on, you will be given a target rate. Okay, so in this question, even the target rate is given. The target rate, I think, is the 20% or so. So if you calculate your IRR, if you fall short of that target rate, then you don't execute the project. Well, if you attain that target rate and beyond, then you execute the project. Okay, so the way the IRR goes is you will calculate 2 NPVs. Okay, so that means you have 2 rates and 2 NPVs. Then you apply a formula on it. So the formula will always be, the formula is also very easy to calculate, is the rate of the lower discount factor plus the present value of the lower discount factor over the present value of lower discount factor plus the PV of higher discount factor. Okay, all that in brackets, multiplied by higher discount factor less lower discount factor. Okay, so once you calculate your two discount rates, let's say 14%. If you use 14%, okay, if you use 14%, that may give you a positive NPV. Then you go a bit higher than that. Let's say you use 17% or 18%. Once you go higher, if you use one rate, if it gives you a positive NPV, to get a negative NPV, you have to go higher. Okay, usually between 2 or more. So you could say if you calculate 14%, it gives you a positive NPV. So go for +3, let's say 17%, that should give you a negative NPV. So you should have a rate that will give you a positive NPV, and you have a rate that will give you a negative NPV. Okay? How do you get that rate? Because the next question should be that. So to give you a guide, first you have to calculate your ARR. Calculate your accounting rate of return and take 75% of that accounting rate of return. When you do that, you can never miss it. So that would be your first number. Okay? After getting that first number, that will be your first rate. Calculate your NPV. Just calculate your NPV, right? Get the discount rate and then the NPV. So if the discount rate is smaller and it gives you a positive NPV, you go for a higher discount rate. That higher discount rate should give you a negative NPV. Then you use those 4 numbers and substitute it in the formula, and then that's it. That gives you your IRR. So I'll give you the IRR formula also, and then I will how to call it? There's a question that was done. I'll give you the solution to that question as well. It's very, very simple. So what is more critical for me, what I want you to do, and what everybody must do before the exams is, I'm telling you, try to understand this question we did called Treco Limited. I think I'm being generous enough to you. Okay? It's something like this is a must in the exam. Even if some people want to speak fuller to me on exam day, no problem. I'll still be able to hear it. Rosa on that, yeah?
Mr. Fofana.
Roger that.
Yes.
This one that you just explained, when you are sending the video, can you also explain it that way and send the video of that allowance with the solution?
Okay, for the IRR.
Yes.
But it's it is very, very simple. IRR. Once you understand NPV, okay, I can do that. It's okay, I can do that.
Yes, please, so that we can go over.
Yeah, no problem.
But this question seems to be very tough. And the comment part, you did
the comment part is the IRR. Oh yeah. Sorry. The comment part, the first part, yes, to your solution. So you've calculated and your NPV is 106,000. Okay, 106,000 is your NPV. So you will say the net present value of this Treco Limited is 106,000. Okay. Then you'll go further and say, based on financial reasons, this is a positive NPV, and as such, the project should be executed.
Okay.
Okay. So that will just that should suffice on your after calculating
so
the
project should be continued.
The project should be executed. You know, why are we doing all this? We are doing this because we want to advise management to whether to go ahead with the project or not.
Okay.
All right.
Okay, sir. Thank you.
Okay, so when do we take our exams?
Mr. Fofana, go down to the answer this thing. Let me see. I want to write down the last part.
Mari, if I were you, don't bother yourself, because I'm going to convert this into Excel. I'll send it to you, and then you'll get the link to this one also.
Yeah, I'm just done. It's not this the working part. It's the other part, the last part. While you are explaining, I can just.
Okay, fine.
Yeah, the last.
Oh, you got it. Okay.
Go down a little.
I go down a little bit. Okay. Is it okay like this?
No, it's not the work. Okay, okay. Thank you. This is the leave it. Thank you. You see, I don't
I don't know why it's still- Huh?
It's too much.
As near practice, it won't be a problem. You'll be able to do it within. And okay, so the exams. Let's discuss the exam. The exams is going to be 3 questions, answer 2. Okay, 3 questions, answer 2. It's going to be 2.5 hours for the exam. So every question you will be given 1 hour 15 minutes. Okay, that's not bad, isn't it?
Mr. Fofana, you know this question we just solved can take you 2 hours plus. This question is very long.
No, I'm telling you, it's because you are doing it for the first time. It's really not difficult at all. It's not difficult at all.
Okay.
Yeah. So when let's agree on a date. Start. Let's agree on a date.
We can discuss that in the WhatsApp page because most of them are